Hey, welcome back. My name is James Johnson. My expertise lies in retirement and estate planning. And what we're going to talk about today is we're going to talk about Roth conversions. Now, what I want to tell you is that the best tax planning is always done before the end of the year. So when's the last time your accountant came to you and said, listen, I've got some ideas about how we can save on taxes this year? Probably never. They don't talk to you until January, February, March, April, May. And the problem with that is the best tax planning needs to be done by 12/31. So let's talk about what is a Roth IRA. Well, it's a type of retirement account that allows you to contribute after-tax dollars into an account that can grow tax-free. Unlike traditional IRAs, which allow you to contribute pre-tax dollars and pay taxes on withdrawals in retirement, Roth IRAs offer tax-free and tax-free withdrawal in retirement. So here's how it works. You contribute the money to your IRA from your regular income that you've already paid taxes on that income. The money in your account grows over time, potentially earning interest, dividends, capital gains, all of which are tax-free. When you reach your retirement age, which is currently 59 and a half, you can withdraw the money from your account tax-free, including all the earnings and or gains. Roth IRAs have some other benefits as well. For example, you can withdraw your contributions at any time without penalty, although earnings or gains may be subject to taxes and penalty if withdrawal prior to 59 and a half. Additionally, there are no required minimum distributions with the Roth IRAs, meaning you're not required to start taking withdrawals at a certain age like a traditional IRA. Now, keep in mind that if you withdraw the principal that you put inside of a Roth IRA, you cannot put it back. You can only put back whatever your limitations are for that particular year. However, there's some income limits for contributing to Roth IRAs, and contributions are limited to certain amounts each year. In 2023, for example, the maximum contribution is $6,500 per year and $7,500 if you're 50 years or older. It's called the catch-up. Overall, a Roth IRA can be a powerful tool for building a tax-free retirement account, but it's important to understand the rules and the limitations. So what is qualified money? Well, qualified money is tax-deferred money. This is money that you put in prior to taxes, and you get a tax write-off for it. The exception to this is under qualified money, a Roth IRA is also considered qualified money, but it grows tax-free and it goes in after taxes. IRAs, SEPs, 401ks, 401as, 403bs, 457, defined benefit plans, etc. are considered qualified money. There is penalties of 10% for withdrawing prior to 59 and a half. You must start taking RMDs or required minimum distribution now at the age of 73 or 75, depending upon your birthday. It used to be April 15th following your 70 and a half birthday, but now it's moved up to 73 and 75 in accordance with the Secure Act. Now, non-qualified money is your taxed as you go money. It's not a government plan, so each and every year as you grow on that money, you're going to get a 1099, and that goes onto your tax return, into your AGI, and you're going to have to pay taxes on it. Some exceptions on tax-as-you-go money might be bonds. CDs, stocks, bonds, mutual funds, etc. are considered non-qualified money. Now, the question comes is, do you keep deferring your taxes because I want more of your retirement? That's Uncle Sam. Well, I think the thing that you really need to understand is that you're not deferring taxes. What you're deferring is the calculation out to a point in time where you're not sure whether that tax rate is going to be lower, higher, or the same. So how does a Roth compare to an IRA? Well, an IRA is tax-free contributions. So that means you get to put into the IRA, and you get a deduction for making that contribution because it's pre-tax dollars. There's a penalty for taking it out prior to 59 and a half. You have to take what are called required minimum distributions at either 73 or 75, depending upon your age. There's a penalty if you do not take those contributions, or distributions rather, somewhere between 25 and 50%. It's taxed at distribution at whatever your tax rate is at the time. Now, Roth IRAs, you put the money in after you pay taxes on it. So any money that you put in there, you've already paid taxes on it, and there is no deduction for putting it in. The principal is liquid from day one, so anything you contribute to the account, you can take out at any time. But do keep in mind, you can't just put it back anytime you want to. You can only put back under the limitations of what you could contribute for that year. It's tax-free after 5 years or 59 and a half, whichever is longer. So you can take out not only the principal, but you can take out the growth after 59 and a half or 5 years, whichever is longer. There are no required minimum distributions, and it passes on to your heirs tax-free. So the worst money that you could pass to your heirs is your qualified money, which would be your IRAs, 401ks, etc., because you pass it with a bomb in it. And some of the best money that you could pass on to your heirs is your Roth IRA and or your life insurance, because it comes to them tax-free. Now, what are the benefits of a Roth IRA? Well, it's tax-free income. There are no required minimum distributions. And at age 73, you can continue to contribute to it, which you wouldn't be able to do with an IRA. However, you could still continue to contribute to a 401k as long as you were working, or your 403b, etc., as long as you were working. Roth conversions cannot be reversed. It used to be that if you made a Roth conversion and you converted too much, you could go all the way up until October 15th of the following year and do what's called a recharacterization. But as of the new Secure Act, that is no longer available. Roth funds pass on tax-free to your beneficiaries. Beneficiaries can stretch that income tax for 10 years. So it used to be that you could stretch your qualified money over the lifetime of your beneficiaries. But in this particular case, the way the rules are written now, you must distribute all qualified money within 10 years. The exception to that rule is that your spouse. So if your spouse wants to, your spouse can still take and move the inherited funds into their own IRA and move it over their lifetime instead of 10 years. There's no taxation on distribution at trust tax rates with regards to a Roth IRA, and it removes the uncertainty of what future tax rates might be. Offsetting losses in the market. Reasons to not have a Roth IRA. Well, you have to pay taxes today, and many people do not want to pay taxes today, but I think after you learn a little bit here about where taxes have been and where taxes are likely to go, you might want to reconsider that thought. There is no tax deduction for making contributions into a Roth IRA. Early withdrawals of growth are subject to a 10% penalty. Keep in mind, we can take out the principal at any time, or what we deposited in the account, but we can't take out any growth until 59 and a half or 5 years, whichever is longer, or we do pay a 10% penalty. You don't have outside funds to pay the taxes. Well, if you're contributing to this account, then you could simply not contribute as much to the Roth that you would contribute to the IRA if you don't have the outside fund to pay the taxes. You need the funds today and have no desire to leave money as a legacy tax-free to your beneficiaries. Well, I would tell you that most people don't plan to fail, they fail to plan. And most people aren't planning enough to keep enough money away. So if you're going to be putting away money for your retirement, you want to consider, does that money go into tax deferred or does it go in tax free? And in most cases, tax free makes the best sense. You need the tax deduction today. So you believe that your tax rates today are higher than you're going to be paying when the time comes to take it out. And what most people find when they sit down with me and they actually do a full-blown financial plan, that often they're going to end up in the same or even a higher tax bracket when they retire. You believe you will be in a lower tax bracket in the future than you are today, as I just said. Now, historic tax rates. Well, what do you think the highest income taxes have ever been in the United States since the establishment of the IRS and taxes in 1913? Well, that highest rate over that period of time has been 94%. The average over that period of time has been 58%. Now, this is our national debt as we see it. So right now, our national debt is $33,622,000,000,000, and the unfunded deficit for Social Security, Medicare, and prescription drugs is $210 trillion. We're currently $243 trillion upside down, and our national budget, if you look down under U.S. federal spending, you can see it's $6.1 million, but we spent $1.7, so we have a budget of $4.4 trillion, but we spent $1.7 trillion more than we brought in just this year. So if you understand that currently we're at a tax rate of 30% top marginal tax bracket. We've been as high as 94. Our average has been 58. We have an unfunded deficit of $210 trillion with a T, and we have a deficit of $33 trillion. We spend $1.7 trillion more than we bring in, and the only budget that we have is $4.4 trillion. You could only imagine that tax rates will be higher in the future. So who should convert to Roth IRAs? Well, anyone that is younger and has a traditional IRA. I would tell you that if you're under the age of 40, you probably should put $0 inside of a tax-deferred account going forward. A beneficiaries of an IRA is a trust. Wealthy people who don't need, want, or likely not going to use their required minimum distributions in their lifetime. You believe you will be in the same or higher tax bracket in distribution years. And if you don't believe that, we probably should sit down and do a plan to find out where you're actually going to end up at. And you have access to outside funds, such as non-qualified money, to pay the taxes in the conversion. How will the taxes work? Well, if I convert money this year, and it's important to understand that all conversions in order to count in that tax year must be done by 12/31 of that year. If I convert that IRA over to a Roth IRA this year, I have to pay those taxes by April 15th, 2024. Now, there might be some exceptions to this. You might have some estimated taxes that you have to pay, etc. This is something where you're going to have to encounter that question with your accountant. IRAs converted in 2024, April 15th of 2025. It's important to know that taxes will likely go up and income may have an effect on Social Security, AMT, and other incomes. Now, how does that work? Well, what that means is that despite what we were promised in the 30s when Roosevelt put Social Security in place, we do what's called means testing on Social Security. So if we're getting other income from other places, a reportable taxable income, then our Social Security can be taxed up to 85% of our Social Security. Now, if you want to know more about that, go over and watch the videos on our YouTube page about Social Security and how Social Security works. So, do you have to convert it all? I've got $1 million in my 401k or my IRA, and I don't want to convert it all because I'll have to pay tons of taxes. Well, that would be incredibly stupid. You are not required to convert the entire amount of your IRA. You can convert it in small amounts over a year period. Now, I always say, look, how do you eat an elephant? And the answer is in small bites, one bite at a time. And most people, when it comes to qualified money, own an elephant. And in order to get it over to tax-free, they're going to have to eat it one bite at a time. The pro rata rule. Now, occasionally, and this doesn't happen often, but occasionally people have made contributions into their IRA which are non-qualified contributions, meaning they already paid the taxes on the money they contributed there, which means that they have a basis inside of their IRA. So just as an example, if we had a IRA and it had a $100,000 value, and $50,000 of it was after-tax money, and $50,000 of it was pre-tax money. If we took any money out, we have to take it out what's called pro rata. So if we were to withdraw $20,000, $10,000 would have to come from the after-tax, and $10,000 would have to come from the pre-tax. This is to keep you from taking out all the after-tax money at once and converting it. You have to convert it all together, all over an equal period of time. So should I convert now or should I convert later? Are your accounts currently depressed or in value? Do you believe you will make more money in 23, 24, or 25? Do you believe tax rates will be higher in the future? And keep in mind that in 2025, the Trump's tax laws sunset automatically. Do you have room in your current tax bracket to max it out? Now, this is an important question because the number that you should be looking at converting should be maximizing your current tax bracket if you believe that your tax bracket will be lower, higher, the same in the future. And for some of you, you might even consider moving up 2 tax brackets as far as conversion goes. Yes to any of these, then now is probably a very good time to do a conversion. So how do you maximize your current tax bracket? Well, let's use a married couple, for example. In 2022, they have taxable income of $340,100 and remain in a 24% tax bracket. If you're in a 24% tax bracket, you should likely convert to the top of your bracket, as in the future, you'll be in a 25 to 28% tax bracket when the tax law is sunset. And when one of you dies, the other one's going to be paying higher taxes because now they have to file single. And this is one of the things that people rarely think about. That, well, right now I'm in a 24% tax bracket. But they don't understand that if there's a death of one of the married couple, that the other one's going to have to file single, and rarely does the income go down by much, because really all they lose at that point in time, especially if they're in the distribution phase of their life, is one set of Social Security. So these are the current tax brackets, and if you understand how tax brackets work, you can see that down we have a column for single, married filing jointly, married filing separately, and household. So we'll just look at married filing jointly right now, and you can see between $0 and $22,000 of your taxable income. So you have what is called AGI, your adjusted gross income. Then you take off your deductions, and that leaves you with your taxable income. So the first $22,000 of your taxable income is taxed at 10%. Between $22,001 and $89,450, you're taxed at 12%. And then 22, 24, 32, 35, and currently the top marginal tax bracket is 37%. So what's the difference between marginal taxes and effective taxes? Because frequently your accountants say, well, your taxable income is only 12%. Well, that's what's called your effective tax rate. So if you were to take your AGI, your adjusted gross income, and you were to divide it into the amount of taxes you paid, you would come out with what's called your effective tax. But you see, it's important to understand that any tax deductions and any new taxable income goes into the higher or marginal tax bracket. So let's just say, for the sake of argument, that you currently had $190,000 worth of taxable income, and you got another income coming in of, say, $50,000 a year. Well, that $50,000 a year, married filing jointly, would now be taxed at 24%. Get it? So it's important to understand how these tax brackets work and when and where should you capitalize on the tax brackets as you go. But my accountant says that, I shouldn't be doing this because in the future I'm going to be in a lower tax bracket. Well, I think it's important to understand that your accountant's job is to save you on taxes today. And I ask you again, has your accountant ever come to you in August, September, October, or November, or December and said, listen, I have an idea on how we can save on taxes this year? I doubt that's ever happened. Accountants, although they're great people and they do a very, very good job at what they do, their job is to save you on taxes, and rarely do they look to the future. Often they're reactive instead of being proactive, and your job is to become proactive rather than to be reactive. So if you were a farmer, would you want to pay tax on the seed or on the harvest? And when you're deferring taxes out to the future, you're paying taxes on the harvest. When you're doing it in Roth IRA, you're paying taxes on the seed. Understand there's two parts to this game you're playing. You're over here trying to accumulate as much money as you possibly can. Market's going up, down, no big deal, just wait, it'll always come back. But you're moving to a period of time which is called distribution and preservation, which is my world. Remember, my expertise lies in retirement and estate planning, and I can tell you, if you knew what I know, you would play the game differently. And that's what I'm trying to teach you right now. It's a pretty good chance you should be moving to tax-free in some fashion or form, whether that be in a Roth conversion or something else. My financial planner said, my banker, my lawyer, my accountant. Well, don't believe everything you hear. You see, many of these people that are advising you are in the exact same box that you're in, and the directions are on the outside. So you took the time to watch this, you probably should be taking the time to sit down and let's do a plan and find out if you should be doing this or not. So how do I trust the government? I hear this all the time. What if they change the rules? Well, here's what we know about tax laws. Always in the past, when you had a tax law, which was a law and not something where somebody was skirting the law, they always grandfathered them. All right, so if you had a Roth IRA, then they got rid of Roth IRAs. They couldn't get rid of Roth IRAs that were in existence. They could only stop you from putting money into them in the future and or converting to them. Roth IRAs are funded with after-tax dollars. The government needs taxes. So in many cases, it makes sense for the government to be doing this stuff right now because they really do need the money. If they do away with tax-free, people will stop contributing and go back to tax-deferred, and they'll get less money now. If somehow the government changes the rules, existing accounts may be well grandfathered, judging by the way Congress has acted in the past. Now, no one can tell you that for sure, but as a general rule of thumb, that's how it works. The sooner you act, the greater your chance of grandfathering. So it's important to understand there really only are three ways to grow your money: tax as you go, tax deferred, and tax free. Which is the best way? Well, let's start by asking which is the worst way. The worst way to grow our money is tax as we go. We put the money inside the account. At the end of the year, we get a 1099 and we have to pay taxes on it. The sad part about that is most of us do not reach into the account to pull out the money to pay the taxes. What we do is we reach into our pocket and pay it out of our lifestyle. Now, the next two better ways to grow our money is tax deferred or tax free. What makes tax deferred better than tax free or tax free better than tax deferred? And the answer is simple. If you're able to put the money in a tax deferred account, say an example of 30% tax savings, and you're able to take it out at 30% tax savings, you break even. But if you're able to take it out where you're actually at a 20% tax rate, then the reality is you have actually saved money. But if you have to pay anything higher than 30, you've lost money. Now, there's several ways to grow our money tax-free, and today we're only talking about doing a Roth conversion. But one of the most dynamic ways to do it is to use something called the maximum funded life insurance policy, either with Index Universal Life or Whole Life. So how can we help you? Well, we play the second half of the game. Our expertise lies in retirement and estate planning, and I can assure you that game is played very differently than your accumulation side. We're all about safety and predictability, and we help people like you grow your wealth and protect and preserve your life savings and plan for distribution of that savings in the most tax-advantaged manner while living and in death, and create streams of income that you cannot outlive. So be sure to go below here and subscribe to our YouTube channel. Visit our website and scan this code and go out and set up a no cost, no obligation appointment with us so we can show you whether or not you should be building a tax-free account, tax-deferred account. Is your retirement plan working? What are we doing here? Are you going to make it or not? Remember, live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling and make it a great day.